I wanted a passive stream of income, but like many people, I thought the way to do that was to buy a single family home. And what I soon found out was that that's not passive. And so I didn't want the tenants, toilets, trash, and the trouble and the turmoil. I finally realized I have to find something else. And that was multifamily investing through syndications.
Hello and welcome to another episode of the Jack Bosch Show. I'm super excited to talk about multifamily today, and from the capital raising side of things. And my guest today is Alan Lomax. Alan, let's jump right in. How are you doing today?
I'm doing great, and it's good to be with you today, Jack. I appreciate the opportunity to be with you and with your audience today.
Wonderful. Thank you very much for being here. So let's jump right into it. So tell us what you do.
Well, I create opportunities for fulfilled and busy professionals and entrepreneurs who are satisfied in the work of their calling and who are not interested in leaving that, but who, like myself, probably have some insecurities around the fact that we're exchanging our time and our effort and our energy for money. And that being the case, there could be a lot of reasons that could prevent that. A sudden illness, an accident, whatever it is, could come along and prevent us from contributing our time, effort, and energy. And that would mean the loss of an income. And so I had a need, and that need was that I wanted to reduce this chronic low-level anxiety that I was suffering from. And so to do that, I started looking around, and like many people, I came to the conclusion that real estate was the way to go about doing that. So I wanted a passive stream of income, but like many people, I thought the way to do that was to buy a single family home, fix it up for rental or fix it and flip it. And what I soon found out was that that's not passive. And so I still had a lot of stress to deal with. And you can hire a property manager, but you have to manage the property manager. And who's going to make the big decisions? It's not going to be your property manager. It's going to be you who are making those big decisions. And the other problem I discovered was that it's really difficult to scale on a single family basis. Just think of acquiring 10 properties and think of the work and frustration that comes with that. Add that to 120 and you get the picture. It's just no way to scale. If you're satisfied in the work of your calling and you want to continue that, you really want a passive stream of income. And so I didn't want the tenants, toilets, trash, and the trouble and the turmoil and toil that comes with that. And so I finally, after 6-7 years of frustration, trying to develop a passive stream of income, going through that single family process, I finally realized I have to find something else. And that was multifamily investing through syndications.
So I totally agree that a lot of that's one of the driving forces, or has historically been one of the driving forces for my wife and I, that we basically thought, first of all, we wanted to get out of our jobs, so we did that. But then even when you become a full-time real estate investor, if you only flip, it's like a much higher paying job in a way. It's a much higher paying activity. So it has its place because it helped us make a lot of money. But then ultimately, if you get ill, if you have a disability, if you have something happens and you cannot continue that income producing activity, your income stops. The way to prevent that from becoming a real issue is by actually taking some of the money that you make. I love that. I like what you say, that like in the line of work of your calling, very few people work in the line of work of their calling though, but most people work in the line of work of their tolerance or the line of work of where they're making good living and not suffering too much. But take that money and roll that into other asset classes. So with that said, do you syndicate or do you raise money to invest with other syndicators?
I raise the money to invest with other syndicators. So I'm a part of the syndication team, but I'm not the primary syndicator. I don't do the acquisition, and I understand the underwriting, and I always go through the underwriting with every syndicator that we work with and every property that we invest in. But I'm not the numbers guy, but I always go through that. I'm not the asset manager. That falls on another person as well. And so my job is capital raising and then the investor relations aspect of that. So I, throughout the whole entire process, I'm in touch with the investors and being totally and completely transparent and sharing with them exactly what's going on with the project throughout the whole period. So that's what I do.
So in essence, you're basically the investor relations guy, but also the raising funds guy. And so you work with different syndicators. You look at the underwriting. You obviously need to understand the underwriting yourself, and to make sure, yep, this is a deal I want to be involved in. This is a deal I can stand behind. And then you go leverage your contacts to help raise funds for that. You're part of the GP, right? The general partnership side of things, but a small part of it, and you're part throughout the entire journey of the property. So you take an active role in the management, not necessarily in the asset management, not in the property management, not in those pieces, but in the investor relations, which then also, from a legal point of view, should be that's I think how you properly do it, in order to make sure that there's a lot of people out there just like, yeah, well, I'll help you raise money, and they can get in trouble with the SEC. The way you do this, that without being an attorney or things like it, seems to be the safer way. Have you looked into that and made sure that it is?
You're absolutely right. Yes, you cannot go out there and just raise money. The SC, the Securities Exchange Commission, will be down on top of you instantaneously. So if you're raising capital, you have to be a part of the general partnership.
Yeah, and not a fake part of it, a real part of it, which is thus. Yeah, that's why when you said that you're actually accompanying the investors throughout the entire journey into the entire path of the investment, that makes you a real part of it. Not just real in terms of actually having a percentage of the sponsoring part, but also being continuously plugged in, being informed, being in the meetings, knowing what's going on the property and communicating that to the investors. Well, that's really cool. So how did you, other than wanting to alleviate that low level anxiety, which made me smile because yes, a lot of people have that. I mean, if you're honest, if you're watching this here, how do you have a little bit low level anxiety about the ability to retire in style, or that your pile of money disappears, or that with your earning ability perhaps disappeared, what happens to your family, and so on and so forth? Those are very, very familiar things to particularly higher earning income people. You think that the ones that earn a higher income are like, oh, cool, I'm good. No. If you're used to a higher level lifestyle, you're also worried about losing that higher level lifestyle, and you're worried about what happens to your family if your income ability stops. So I think it's a very, very well positioned role that you have chosen. But other than this like alleviating your own kind of thing, how did you come up with that as a strategy? So like, you know what? Let me become the money guy for multifamily properties. I mean, I understand multifamily makes sense, but how did you come up with that kind of, in a way, business model for you?
Well, as I was learning and studying, and I had made a firm commitment that I'm moving from the single family environment to commercial, and multifamily is the place that I'm going to focus. but I thought, well, I'm going to go into this and I'm going to be the lead GP on this. I have a realtor's license. I've been doing rentals and so on and so forth. So I'm familiar with the territory. So I'm going to do it. And as I started getting into that, I also realized that a very important part of the syndication process is capital raising. And it is in and of itself a job in and of itself. And it's a critical part of that process. And as I was looking at the various different roles of asset manager to acquisitions to underwriting, uh, I just was like, I want to be a capital raiser. That's where the fun is. That's where the interaction with the investors comes in. And so it was, I mean, it was actually looking at all of the various different roles in a syndication and deciding that this is the one that fits me the best.
Okay, cool. Yeah, I mean, you're right that this is one big epiphany that we had too when we added multifamily and we own close to 1,000 units that we are either GPs on or that we are very very significant LPs on, but most of them are we're GPs or in one property. It's a tenants in common situation where four of us own 258 units. So I'm technically kind of taking the role of a limited partner there, but I own 25% of the property. So it's like a significant kind of piece of 258 units. So with that said, when we added that, we realized that we just added an infinitely more complex investment method in addition to the land flipping that we have been traditionally doing, where we're just simply taking a piece of land, put it on a contract and sell it to somebody and doing land wholesaling without touching the piece of land and with now not much other things being involved. And just the qualifying for it. So do you have to have a certain net worth to qualify for a certain kind of property? That you have to be underwritten with Fannie or Freddie in order to be actually get a loan with Fannie and Freddie and so on and so forth. So it's an entire process. The fundraising part of it is often the one that particularly general partners or operators struggle with the most. So you're definitely fulfilling a good gap there, of filling a good need there. So what's some of your experience when you're raising funds? What's the biggest challenge that somebody might have when now that you're in that role? You said that's the fun. Well, how does a fun look like, basically? What is your most fun activity when you raise funds?
Well, there are two myths that get in the way. One is the first thing we were talking about. A lot of people that I talk to are currently investing in single family properties, and they are under the same delusion that I was under, that this is the way that they're going to develop a passive stream of income. So I have to address that particular myth. But the larger one is that the second myth is that you have to be a millionaire to invest in commercial real estate properties. And the reality of it is that anyone who has been in their profession for 5 to 10 years or so, or if you've been an entrepreneur and you've been successful as an entrepreneur, you already have the money to invest in syndications. It and you probably not even aware of that, and you probably have retirement accounts, 401ks, or IRAs. There's a good chance you have some life insurance policies that can also be utilized. You may have a fair amount of savings in low performing stocks or in CDs, and so uh, almost certainly, almost everybody who's been in their working environment for 5, 10 years or so have their own personal home, and they probably have a fair amount of equity in that home. And that actually was how I finally got started into multifamily investing, was through home equity loans.
Quickly, are you typically funding 506B or 506C syndications?
Well, we do. I work with both. It's becoming more frequent that they're 506c, but there are still some individuals doing the 506b.
And can you quickly explain the difference to the audience?
The 506c is kind of a come lately aspect of the SEC. And essentially what that does, it allows the syndicators to actually advertise broadly. But the drawback on that is that you have to be a cert an accredited investor to invest in a 506c. And accredited investor is someone who has at least $1 million in assets outside of their residential home, and either that or they, as a single individual, they make $200,000 a year and have to have had that for the last 2 years, with the expectation of having that going forward. If you're married, it's I think it's 350 minimum that you have to qualify as an accredited investor.
So when you said earlier that you don't have to be a millionaire for that, then you're referring to the 506b, which is the level lower, which is not level lower, but it's a syndication type where you also allow up to 35 non-accredited investors, so-called sophisticated investors, that just have to have, there's no real specifications of what their net worth needs to be and what their income needs to be. I usually like to say, we do 506bs, that if you're not accredited, I can't take your last dollar, like very simply. So I was like, if you have 200 grand on the line, you can invest 75 to 100, probably not more. I won't take more of your money, because very simply the SEC says like you're sophisticated, you understand the risks, you understand what's involved, but I just don't, and probably they're seeing it similar. They don't want you to invest all your money into one kind of thing. So we always ask the question, how much do you have to invest? And they're like, well, $50,000. It's like, then it's not a match for us, right? I don't want to take your last $50,000. Or you only $50,000. If they say $500,000 and you want to invest 100 grand, totally fine. If they're like somewhere in the 50% of what they have with like $100,000 left, that's kind of where I usually do the threshold. Do you see that to be a safe threshold?
Yeah, and I mean we go through the same thing. I mean we always have a one-on-one consultation with everybody, whether they're accredited or whether they're new investors to the process. We don't just let somebody just come in and slap down 50 grand. We want to know who they are, and we want to know their financial situations, because I mean, all investments are a risk. And since doing this, I have never lost anybody's capital and have always returned good returns, but there's always a risk. And you don't want people putting in their last dime. That's not a smart way to go.
Absolutely. Makes sense. So great. So typically what kind of properties do you decide to get involved with? Do you have a kind of like a buy box that you say like, this is the kind of property and that I wanna raise funds for?
Yes, I like that buy range of built after 1980 up to 2015. And I prefer 100 to 200 units. But more than the property, I'm really much more interested in the syndication team. And I'm interested in their experience and their track record. I'm interested in who they are as people. I want to know what their ethics are. I want to know what their values are. And I really do not get involved in capital raising with people that I don't know, and whose track records I haven't been able to really track and see what's really going on with them. So it's really the team more than the property, because when I said my buy range is 1980 to 215 build, with 100 units to 200 units. I have worked with syndicators who are outside that realm. There's some 70 built properties that are in the portfolio, and a couple of properties that are 230 to 250 unit properties. So, and actually, there are a couple where I think there is 30 units that we have gone as small as 30 units. So it's the team, and then secondly, it is actually the underwriting and uh, and the LO, the operating agreement. So what are they going to do with the property, and what is the potential here? That's really what the criteria is.
Very cool. Very good. Yeah. No, that makes total sense. That shows that you're a man of integrity that wants to focus on only protecting their investors' money and only working with people that have a really, really good track record. And again, we do our own deals, but we operate the exact same way. So I can totally relate to that. So what are you seeing happening right now in the market? What do you see as the challenges? Are you getting a lot of deals that you to raise money for? Are you seeing distressed deals coming into the market? Are you seeing syndicators being excited? Are you seeing them being worried about what they're holding? What do you see out there?
Well, it has been really tough lately to find properties that really are good deals. I mean, it's been really tough. The syndicators I work with are looking at some 300 properties to find one deal that is working. Of course, we keep hearing that all of these bridge loans are coming due that came together in 2000 to 2022, and that there's supposed to be a lot of distress. And they keep telling us that, but we're not really seeing a whole lot of that. I keep hearing rumors that it's still just around the bend, but we're still.
It is happening too, partly. It's like we just closed 2 weeks ago or 3 weeks ago. We closed on a 91 unit property in Fort Worth, Texas that was distressed. They were the sellers were about to hand in the key. They couldn't do it. They couldn't recapitalize. They couldn't refinance out of their bridge loan, and they ended up losing $4 million selling that property to us. And we got a smoking deal at the 7.5 cap in the Fort Worth area. But so they do exist, but they're being snatched up quickly, so I just want to throw that in. But yeah, other than that, like the rumors are like, where are they? Why are they? Why are they? They're not easy to find. Let's put it that way. Yes.
Exactly. And I mean, maybe the snow slide is coming. They keep telling us it is, but it's still pretty challenging to find those properties.
Yeah, absolutely. So, and then with the existing properties that you have in your portfolio and overall with the market, what do you expect the market to do in the next couple of years?
Well, it seems like interest rates are going to stabilize, and the demand for rentals is not going to go away. There clearly is a housing shortage. I mean, there is a huge housing shortage, and so people are going to continue to need places to live, and it doesn't appear with the housing shortage that purchasing prices of single family homes are going to be declining anytime soon. Right. And so it is much more expensive to purchase than it is to rent, even though rents seem quite high in many locales. It's still cheaper to rent than it is to buy. So the market looks good in terms of rentals, and it looks pretty promising that that interest rates are going to stabilize. They may even decline a tad bit. I don't really think they're going to, but that's my opinion. But I do think they are going to stabilize. And yes, I mean, there's just too many bridge loans out there, and there are that just were not appropriately put in place and for what was coming. And I think there is going to be a lot of distress. So I think that buying opportunities are going to increase.
I agree with you. So on the bridge loan side of things, what I'm hearing again, we are in a lucky position that we have a few months ago we have been reached out to by some of the lenders that we have done business in the past with, and they basically said, "Hey, Jack, are you buying?" And I was like, I am buying if the price is right and if the deal is right. It's just, as you said, really hard to find a deal that works. And it's like, well, some of these deals that are in distress, they're starting to work their way through the departments. So here's 3 of them. So he threw 3 of us to us. 2 didn't work, 1 did work. So we bought it. And now that we closed on it, it's like, hey, we're ready to take the next one on. It's like, great, some more are coming through the system. What I'm seeing happening right now is they're never coming on the market. What they're happening is they're being handed off to buyers that the lenders have good relationships with, and that's probably one of the reasons you don't see them. But so one of the things that if you're like what you could go to your guys is have them call the lenders that they're actually working with and have them go do the inroads and that, because that's in our case it didn't even happen like that, but the lender reached out to us, one particular lender that we have done 3 or 4 loans with. They're like, and every single time we closed on time, we closed everything that we promised, we were professional in our operations, we did what we said we would do, and when we said we would do it, and we were easy to work with and highly responsive. So as a result, they're like, I want to do more deals with them because I know they can close. So therefore, that started that process. So with that said, what they're also saying is that they're seeing a lot of lenders working out deals with those people, with those distressed owners, that they're giving them extra time. They're waiting to see what interest rates are doing, and I think that's why we're seeing those deals not come on the market yet. Either they're going to people like us or just like many people that they're going hand it off without going on the market. This deal that we just bought never went on the market. We basically agreed on a price that worked for both of us, and it was never hit the market. Or they are very simply never going to go on the market, or at least not for the next year. They're being delayed because it's not in the lender's interest to have them go into the foreclosure process. The lender looks bad in front of the feds. It puts them. The balance sheet starts looking bad because it goes onto the wrong side of the balance sheet, et cetera, and none of that the lenders want. The lender want to keep looking good. And particularly if the lenders already have some office real estate that is already in shambles, they don't want to add some multifamily to that. So what I'm hearing from the lenders is that there's a lot of willingness from the lenders to drag this down and kick that can down the road in the hopes that a year or 2 years from now, the interest rates are substantially lower, and therefore, which nobody knows. I agree with you. I don't think they're going to budge a whole lot, but they're hoping that they will. And then miraculously, with some rental increases and better performances, those properties can refinance into something, and they're saved from being foreclosed on.
Yeah, that's what I suspect is going on. I mean, it's not, a lot of people think bankers are just cutthroats, and maybe they are, but there's just not a whole lot of logic in them just going out there and foreclosing.
Yeah. And it's not my experience, actually, because I've done a podcast about that, and I will do an extra podcast about that perhaps very soon. We have a property in outside of New Orleans that was hit by a hurricane, and the insurance is not paying. So on that property, we have had to drag this property along for over 2 years now. It's going on 2 years or 3 years almost. Before that, and it's not just now coming back to stabilization, because first it took a year and a half between insurance back and forth, and the property was 24% occupied. I mean, the lender could have foreclosed on that thing anytime, or at least threatened to foreclose, but the lender was actually extremely patient, extremely understanding. But again, why? It's because we kept communication channels wide open to the lenders. It's like, we're working on insurance on this, we're working on that. And once the insurance said finally no, they don't want to pay, and we had to sue the insurance, At that point, we said, we're stepping in, we're going to cover this, we're going to go use our own money to rehab that property and then eventually settle with insurance. So we put $3.5 million of our own money into that deal, bringing it back, fully renovating it, now leasing it up again. And the lender is, as a matter of fact, the lenders are wanting to send us more deals now because they have seen that we don't just bail and take off and let everyone standing with their pants down, but instead that we actually are willing to do what it takes and keep the communication channels open. So with that said, my experience has been with lenders that if you keep the communication channels open, that you're upfront with them and honest with them, that they will work with you, they will not pull the plug, because particularly currently, they don't have an interest in doing that at all.
Well, yeah, I mean, it doesn't serve their interest to foreclose, very seldom anyway. And I know it's a last resort for them.
So with that said, when somebody wants to invest with you, what typically are some of the terms? I know they vary from deal to deal, but typically what kind of are the deals that you like the most, like that you like to see the most? Are these like complete repositioning deals with no pref and just like 3 years later it's a complete new deal and boom? Or are you looking for cash flow deals? Are you looking for light value add, medium value add? What kind of deals are you looking for that you like to raise money for?
Well, I like the value add properties because that is the way to return to investors the most significant returns on their investment. And I like the properties that have minimal amounts of rehab. Particularly, what I really like are properties where there's value add because the management hasn't been doing what they need to do, but they have been maintaining the property somewhat adequately. That means we can go in with very little maintenance and repairs, and we can really quickly turn around the management aspect of that. And so not only are we returning high returns to our investors, but we're returning cash flow within 6 months period of time. And so those are the deals that I really, really like, are the poorly managed properties that are fairly adequately maintained.
Good. So there's there's a cash flow component within 6 months that they're getting as a preferred return, and then there's a nice exit at the end with a probably good profit split. What's the typical split at the back end that you're seeing the people you get involved with do?
The typical split is about 30-70, and sometimes we can put a waterfall in there that if the syndication team is performing very well, then we can have a waterfall in there and shift that to whatever, maybe 40-60 or even sometimes to 50-50 on the back end of it.
That's very cool. And that's an interesting example of how you can really structure those things in a flexible way you want to do it. Typically, we do a 70-30 or 30-70, 70 to the investors, 30 to the sponsoring team also, and keep it very simple. So great. So if somebody would like to know more about how to get a hold of you, how to learn more about it, I know you have your own podcast, and we're working on getting me on there too. So if you're watching Alan's podcast, you're soon going to see Jack popping up there too potentially. So how does somebody learn more about you and what you do?
Well, probably the best way to do this, particularly if you are a novice investor, is we have a free webinar, and you can find that webinar at our website, which is steedtalker.com, and that would be /webinar. In that webinar, you'll learn more about the 5 elements that make real estate investing the ideal investment, discover how to substantially reduce your tax liability, learn the secrets of recession-proofing your nest egg, beat the eroding power of inflation, and explore the unique ways to find the syndicators who are passionate about helping you build your financial well-being with higher than average rates of return on the investment. And you'll also learn to avoid the hidden risks that are associated with real estate investing. So a good place to go is our website, stevetalker.com/webinar. And as you mentioned, our podcast is Real Estate Investing Abundance.
Real estate investing abundance. All right. And stevetalker.com /webinar. Go there now and check it out. So with that said, thank you very much for being on the show. Again, multifamily is a beautiful vehicle. We do it. Alan does it. You can do it full time. You can do it as a passive investor. You can look at a lot of deals coming through. You can get expert advice to help you analyze those. Again, there's so many different spots that you can find your home within real estate. If you have a high income job, it might not be, and you love it, it might not be time to quit that, but instead it might time to reallocate some of the investment from a 401k or something like that into real estate, and you can do that without having to do the actual management. So with that said, thank you very much. Thank you, Alan, for being on the show with us. And with that said, that concludes our episode of today's podcast. As always, give us that 5-star review. If you're watching it on YouTube, give us that, hit that subscribe button, hit that notification button. If you're listening to any other platform, go share it with your friends. That's how we spread the word about what we do here. So that's it. Thank you very much. Bye-bye.